Welcome to my channel. I am going to walk you through the process of valuing 3 freight and logistics stocks and analyzing their financial ratios. Comment if you have questions. I respond to every comment. Subscribe if you want to see me value more companies. Become a member of the channel and I could do a more in-depth valuation on the ticker of your choice. The first company we're going to look at is CHRW. This company ships items to customers using trucks, railroads, planes, and ocean carriers. It also offers warehousing. Let's get started with the model. They have a market cap of $13.9 billion, so they're a large cap company. They're trading at 103 a share. And to get the shares outstanding, that's market cap divided by stock price, gives you shares outstanding, 135 million. We're going to need this number later when we calculate the value of the company. Let's look at their financials. Free cash flow is how you value a company. You estimate the future free cash flows, and then you discount that number back to today's value. Free cash flow is cash flow from operations minus capital expenditures. You generally want to invest in a company with positive, healthy free cash flow. But if they have negative free cash flow, it could mean they're investing in their business to grow it later on. You just need to look into those things. This company has positive and growing free cash flow, so that looks good. Their net income also looks positive and consistent. Their revenue seems to be growing quite a bit from 2016 to 2018. It does drop in 2019, but it looks really solid. Their margins are quite low, 3 to 4%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. If you have high expenses, you have low margins. If you have low expenses, you have high margins. Let's look at the capital structure. They have $1.2 billion of debt. They pay 3.86% interest on their debt, and the cost of debt is an even 3%. The way you get cost of debt, it's interest rate times 1 minus the effective tax rate. Their capital structure is 43% debt, which means they have 57% equity. Cost of equity is 7.24%. We figure that out using the beta. That's how volatile the stock is relative to the market. They have a low beta under 1, so that means the stock is less volatile than the market. The market as a whole has a beta of 1. The lower the beta, the lower the cost of equity. The higher the beta, the higher the cost of equity. We use the capital asset pricing model to figure out the cost of equity. And their WACC is 5.44%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We estimated all cash flows past year 4, that's $13.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company at $13 billion. We divide that by 135 million shares. We get a calculated stock price of $98. They're trading at 103. They're trading at a 6% premium, so it's a sell according to the model. Let's see what Simply Wall Street says. They're at $63, so they're saying the stock is overvalued by a lot more than me. Let's see where the stock has been trading at the past few years. This stock is at its all-time high. The price has been driven up the past few months. It could have been a great value if you bought it 2-3 months ago. Let's look at the financial ratios. They have a weak PE. The median for the market is 18.4. The average is 52.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 24. So investors are paying $24 for $1 of earnings. They have a good price to sales ratio. The median is 1.8. The average in the market is 5.1. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.9, so investors are paying 90 cents for $1 of revenue. They have a weak price to book ratio. The median is 2.6. The average is 7.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 8.3, so investors are paying $8.30 for $1 book value. Remember, equity is total assets minus total liabilities on the balance sheet. They have a good interest coverage ratio. The median is 4.8. The average is 15.0. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0. They're at 16.6, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. This is the operating income on your income statement. ROE is really good at 35%. The median is 15%. The average is 28%. ROE is net income over equity. I like to see above 20%. They're at 35%. So they provide a great value to their equity holders. They have a good current ratio. The median is 1.3. The average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2 so they can cover their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on Expeditors, Fedex, and UPS, all in the same industry as CHRW. And if CHRW has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are better in PE. They have the best price to sales ratio of all the companies. They're a little better than average in price to book. The average in the industry is pretty bad at 12.0 because UPS is so high. They're doing fine in current ratio. Even though they have a good ROE, the average is 51%. So they're a little lower than average, but they're doing fine in current ratio. Debt, they're a little below average at 43%. Average is 46%. And they're the smallest company of the four at 14 billion market cap. They pay a higher than average dividend yield at 2%. To summarize, I have them trading at a 6% discount. Their ratios look pretty good and their financials look solid. The second company we're going to look at is Expeditors. This is a logistics and freight forwarding company. Let's get started with the model. They have a market cap of $15.3 billion. They're trading at $91 a share and they have 168 million shares outstanding. Let's look at their financials. Free cash flow looks really good. It's growing and consistent. Same thing with net income, and their revenue is also growing and pretty consistent. So their financials look good. They have no debt, which is great. They're 100% equity, and they have a low beta, 0.84. So the cost of equity is only 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $14.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12.8 billion. We divide that by 168 million shares, and we get a calculated stock price of $76. They're trading at 91. They're trading at a 19% premium, so it's a sell according to the model. Simply Wall Street has them valued at $74.50, almost exactly what I have them valued at. Let's see what they've been trading at the past few years. So it looks like the price of the stock was pretty consistent for about 3-4 years, but the price has been driven up. It's at its all-time high right now, so I'm not sure if it has more room to grow. Let's look at our financial ratios. They have a weak PE, that's stock price over earnings per share. I like to see below 15, they're at 26. Good price of sales, that's stock price over sales per share. I like to see below 2.5, they're at 1.9. They have a weak price to book, that's stock price over book value per share. I like to see below 3.5, they're at 7.0. Good ROE, that's net income over equity. I like to see above 20%, they're at 27%. Good current ratio, that's current assets over current liabilities. I like to see between 1.2 and 2, but 2.4 isn't too bad. The best way to look at ratios is to compare them to similar companies. I've done videos on CHRW, Fedex, and UPS, all in the same industry as Expeditors. And if Expeditors has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're a little better in price to earnings, a little worse in price to sales. They are better in price to book, even though their price to book isn't so good. They have the highest current ratio of all the companies at 2.4. The average is 1.7. They're lower in ROE at 27%, but that's a good ROE. They're the only company of the four with no debt. The other companies are at least 40 to 90% debt. And in terms of market cap, they're lower than average at 15 billion. They have a lower than average dividend yield of 1.1%. The average is 1.7%. To summarize, I have them trading at 19% premium. Their ratios look okay and their financials look good. The third and last company we're going to look at is Fedex. This company is known for its overnight shipping and pioneering a system that could track packages and provide real-time updates, a feature that has now been implemented by most other carriers. Fedex is also known as one of the top contractors of the US government. Let's get started with the model. This is a big company, 64 billion market cap. They're trading at $2.43 a share. and they have 262 million shares outstanding. Let's look at their financials. They don't look so good. Negative free cash flow in 3 out of 4 years, but they have positive net income. The reason they have negative free cash flow and positive net income is because they sold a lot of products on credit. When you sell on credit, you're booking the revenue, so your net income looks good, but you don't get any money for it. You'll get it in the future. They also paid back a lot of accounts payables. When you buy on credit, it helps your cash flow that year, but in future years, it's going to deplete your cash flow. Their revenue looks really good, 60 to 70 billion dollars, so it's a big number. They have $21 billion of debt. They pay 3.1% interest on their debt. Cost of debt is 2.4%. A little over half that capital structure is debt, so they're not too leveraged, which is good. The beta is 1.5, so the stock moves about 1.5 times the market, so it's a little volatile. Cost of equity is 13.76%. We use the capital asset pricing model to figure that out. And the WACC is 7.6%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for, that's $27 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company at $25 billion. We divide that by 262 million shares, and we get a calculated stock price at $95. They're trading at $243, so they're trading at a 156% premium. It's a sell according to the model. I'm at $95, Simply Wall Street's at $124, so they're also saying the stock is way overvalued. It's hard to value a company with so much negative free cash flow, so I had to use a really conservative model just to get a decent value because the other models had a value of 0. Let's see what the stock has been trading at the past few years. Looks like the stock peaked 2.5 years ago at about 270, but it's come down quite a bit, but it's been driven up the past couple months. It looks like it could be really overvalued based off of my model. It really depends on how you feel the future of this company is going to be and how the market is going to react to this stock. Let's look at the financial ratios. So they have a bad PE, that's stock price over earnings per share. I like to see below 15, they're at 49.5. They have a good price to sales ratio, that's stock price over sales per share. I like to see below 2.5, they're at 0.9. A good price to book, that's stock price over book value per share. I like to see below 3.5, they're at 3.5. Good interest coverage ratio, that's EBIT over interest expense. I like to see above 2.0, that's 4.2. They have a low ROE, that's net income over equity. I like to see above 20%, they're only at 7%. Good current ratio, that's current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.6. The best way to look at ratios to compare them to similar companies, I've done videos on CHRW, Expeditors, and UPS, all in the same industry as Fedex. And if Fedex has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in PE. They're better in price of sales. They have the best price to book of all the companies, so they have a good balance sheet. The current ratio is fine. They're not doing well in ROE, they're the lowest of the 4 companies. They're higher than average in debt, and they're a big company. They're only smaller than UPS, but they're bigger than the average in the industry. They have the lowest dividend yield of all 4 companies, 1.07%. The average is 1.7%. To summarize, I have them trading at a big premium, 156% premium. The ratios look a little shaky, and their financials are pretty weak. So let me know what you think of the video. Leave a comment. I reply to all comments. Subscribe if you want to see me value more companies. And become a member if you want me to do a more in-depth analysis on the ticker of your choice. Thanks for watching.